we have with us Mr. Silvan Amber from Certified Tax Expert, and he will be presenting taxation of employee token plans. Silvan, thank you very, very much for being with us today.
Yeah, hello everyone. Thank you, Fabiola, for the introduction. Well, one of the kind of most interesting tax topics that my clients typically face when they are coming to Switzerland and setting up their companies to develop their platform or whatever they do, apart from the topics that Thomas already explained, which is kind of the income tax on the ICO proceeds and the VAT treatment that is very relevant, is when you start to design a plan, or it doesn't even need to be a formal plan, but if you want to incentivize your own employees by giving them those tokens, and that's typically if you develop your own tokens, you also want to use it as an instrument to either pay your employees or at least to kind of incentivize or make them familiar with their own tokens. So there is typically a point in time where you want to give them tokens. And the question comes up, like, how are you going to tax them, right? So if you go to the next slide, the typical case is like for a development company of a blockchain protocol or something that needs an own token and gives it to the employees. Now, Switzerland has quite a lot of regulation and guidance on the taxation of employee incentive plans, like share plans, option plans, RSUs, but these don't talk about tokens. And unlike all the other kind of tax topics where we try to make analogies, the analogies for those plans don't really work because they are so specific, and token is really such a different concept that the tax authorities have developed different practices. So you cannot just say, well, it looks like a share, so we're going to tax it like a share. It's actually different. And the other funny thing is that this Canton of Zurich and Zug, they have developed a completely different way to look at tokens, which is rare because typically tax authorities try to align themselves and they try to harmonize their practice. But here, we're really talking about two different concepts that those tax authorities have developed, and they stick to it. So that makes it a bit more complicated. When we talk employee token plans, it's important to understand it's really about their own tokens. So we're not talking about giving Bitcoins or Ether to an employee. That's just like a salary in kind. That's rather easy because you just need to evaluate those tokens and then you treat it as any other kind of salary in cash or US dollars, like whatever you want to pay. We also typically don't talk about the advisor tokens because advisors, they are normally self-employed or companies that send invoices. So there we treat it as a kind of a service provision and not as an employee token. Employee is really about, I have an employee in a kind of labor contract relationship that I kind of want to incentivize or pay. Also, this practice doesn't apply if you're just giving cash based on the value of the tokens, which is rather unlikely because if you have a token, you typically want to give the token and not just like fiat money that corresponds to the value of the token. But just to be clear, what we're talking about is really your own token that is also kind of a product of the work that your employees are doing in the company. You know, if they work well, the hope is that the token value will increase. So they're getting incentivized because they can develop the value of their own tokens that they're holding. That's why it makes it a kind of employment incentive scheme. Now let's go through the tax practice quickly of like how Zug and Zurich are looking at it, so you understand kind of these different mindsets. What the Canton of Zug says, well, there is no guidance for tokens to treat it as employment incentive scheme, so we don't treat it as one. What we do is we say, well, this token is just like an object, it is a virtual object that you give to your employees, so it's part of your salary when you give it. So you just have to find the right value, but actually we treat it as any other kind of salary. It's taxed when you transfer the token. And they don't really recognize that concept of employment incentive scheme. And the benefit of that is like, it's rather easy, you know, you give it away, you tax it, and then you're done with it. And it's good for the employees because they get it like when it is still a very low value. And if the project is successful, they get tax-free capital gains in Switzerland because there is not really this relationship to their employment that would make it somehow taxable. That's a positive thing. The negative thing can be quite burdensome for the employee because they get the upfront taxation. So when the token is transferred, in that moment, they have to pay tax. So imagine they get it directly during or after the ICO, it has a huge value, and then it drops. You know, it's like the project is not successful, they get nothing in the end, but they have a huge tax bill to pay. Especially problematic if you give them some kind of like vesting or blocking periods that they cannot even sell it. So this like they're stuck with the tax bill, but they're not even allowed to transfer the tokens. They might not be able to pay the tax. So this is a very risky approach. You need to be very careful how you give it to them, those tokens, so that you not kind of kill them on their tax rate. However, there is a rather easy workaround. If you don't want to have this treatment, then just don't transfer the token. Just give them some kind of you promise them tokens, but they're not getting them yet. So they getting them only in the future when the token is listed, when they can sell it. But anytime, like over time in the future, don't transfer them in day one, as many projects have done in the past, because then they will be taxed in day one according to the Zug practice, right? This is kind of the logic of Zug. The logic of Zurich is quite the opposite. They say, well, it's like, let's make it easy. Everyone that gets token, we just treat it as kind of employment incentive scheme, which there is a developed practice for employment incentive scheme, and just apply this. So we're not taxing the employee at all when he gets those tokens, irrespectively of whether he can sell it or not, or if the token is listed, we don't care. We sell it once the employee is actually cashing out. So only when the employee sells the token for fiat or Bitcoin, they will actually have something in their hand that we can value. And it's much easier if we only tax them then. So like that's positive for the employee in terms of like, there's no upfront taxation. They know exactly what they get. When they cash out, they can also pay the tax bill. That's also quite a positive aspect. And many employees actually prefer that over the Zug practice. The downside is like, if the project is very successful, everything that they get is subject to full taxation and social security. So their tax burden, if they live in the city of Zurich, can go up to like 50% if you add in the social security contributions as well, and if they're in the highest tax bracket. So it's really like the high tax solution. And another problem that is often underestimated is the taxable event can happen in the future when the employee is not anymore with the company. So like the employee has left, and 2 years later he sells these tokens. The employer would still be liable to deduct the relevant taxes, like could be source taxes for a foreign employee, it could be the social security contributions, but the employer needs to implement measures to ensure that he actually can comply with that. And if the employee just walks out and takes the token with him, how would he ever like find out, or how would he ever be able to pay the tax on those salaries? That's the big problem with the Zurich approach. And the only way really to work around in Zurich is you give the token to the employee in cash, and the employee buys the token on the market from a third party, not from the employer, because that's the way that you can circumvent kind of the treatment as an employment incentive scheme. Because as soon as I buy something from a third party and not from my employer, it's not an incentive plan anymore. Because the Zurich tax authorities, even if you buy the tokens from the employer at the market value, if you do a valuation, even if you buy it, the canton of Zurich will very likely not accept this and still treat it as employment incentive scheme. So rather a difficult like concept as well if you don't pay attention in how you structure it. Now, question might arise, well, like what does it mean, like if these two concepts are in conflict? Like if I have an employer in Zug, but if I live in Zurich, like which rule do I apply here? Like, doesn't make sense. Now, it's clearly that the employer canton is relevant. So if your company is in Zug and your employee is in Zurich, for example, then Zurich will accept, or will have to accept, the Zug methodology. So that kind of is how it's ruled, and then you just need to figure out like where the employer is going to be located, and then by that you choose also the practice that applies. Then please also don't forget, there is also potentially VAT on the tokens. I mean, Thomas explained these different token types. And if you have a utility token, and if your employee is sitting in Switzerland, you need to be aware that giving them those tokens will constitute a taxable transaction for VAT. So we'll actually have to add 7.7 VAT on the tokens that you're giving to the employee. That's just something that you need to be aware. VAT also applies on tokens given to the employees. In practice, one of the biggest challenges is then like, what is the value of the token? Especially if the token is blocked, vested, not yet listed anymore, like anywhere, like how do you determine the value? And typically the clients come to me and say, well, it was quite early in the project, so the token has no value. Now, tax authorities typically don't believe that, because you wouldn't give away those tokens for free to just anyone, right? So I think it's not really reasonable to assume that the token has no value at all, even in the early stage of the project. Just because you have never sold it doesn't mean you have already put in quite a lot of effort in the token that would give it value. So you need to come up with some kind of a reasonable valuation methodology. If you have a third-party investment round, like a pre-sale, even an ICO, that's of course the strongest benchmark, because someone is willing to pay at a certain time this price for the token. So that's typically the mark that you're using as a reference point. In a very early stage, you might be able to use other methodologies, like the costs for producing it, or like what have you already put in as effort, but it's rather weak in comparison to maybe 3 months later you sold it for like 10 times the price to a third party. Then of course you might be able to add discounts for blocking periods, for lack of marketability. There is Black-Scholes models. There is this kind of 6% discount per year of blocking that you use for shares that you might apply, but there is no clear guidance of how this valuation should be made. So I would definitely recommend to establish a valuation methodology, but then discuss it with tax authorities in order to make sure there is no conflict, because if they challenge it a few years later, you might end up in quite a troublesome discussion with the authorities. Now, summarizing, like, how do you approach this when you want to incentivize your employees? First of all, you have to choose your canton, because by choosing your canton, you choose the system of how it's treated. It's not obviously not the only relevant criteria, but it might influence your decision, like where you're going. Then you have to design your token plan carefully, because these details on how you give the tokens to the employee might be quite relevant in practice, even like further down the road. You need to take care of the valuation, like how do you value those tokens? You need to come up with a methodology, and I would strongly recommend go to the tax authorities and discuss the model with them, because they will be happy to share their thoughts with you, and they give you, normally they give you a clear like guidance on how they look at your specific case, and that gives you a lot of peace of mind and reduces your risks in the future. That was the introduction of employee incentive tokens. If you have any further question, please also do not hesitate to contact me. And if you have any questions here in the chat, I'm happy to answer them.
Hi, like Silva.